Did you know how gross profit differs from net profit? Did you know a business can earn huge sales revenue but still end up with very little actual profit? And did you know accountants calculate profit in different stages to understand the real financial performance of a business? Two of the most important concepts in accounting are gross profit and net profit. Although both represent profit, they are completely different in meaning and purpose. What is gross profit? Gross profit is the profit earned after deducting only the direct cost of goods sold from net sales. Direct expenses are expenses directly related to producing or purchasing goods. Examples include cost of raw materials, purchase cost of goods, factory wages, manufacturing expenses, carriage inward, freight on purchases. The formula for gross profit is: gross profit mainly measures the efficiency of production or trading activities. It helps businesses understand whether products are being sold at a profitable margin. Understanding cost of goods sold. To calculate gross profit, businesses first calculate cost of goods sold, also called COGS. The formula is: suppose a business has opening stock is equal to 20,000 rupees. Purchases is equal to 50,000 rupees. Direct expenses is equal to 10,000 rupees. Closing stock is equal to 15,000 rupees. Then, COGS is equal to 65,000 rupees. If net sales are 1 lakh rupees, then gross profit is equal to 35,000 rupees. This means the business earned 35,000 rupees from its core trading activity before paying other operating expenses. What happens after gross profit? Businesses have many other expenses apart from product-related costs. These are called indirect expenses because they are not directly connected with manufacturing or purchasing goods. Examples include rent, office salaries, electricity bills, advertising expenses, insurance, office maintenance, interest on loans, taxes. These expenses are necessary for running the business on a daily basis. What is net profit? After deducting all indirect and operating expenses from gross profit, the remaining amount is called net profit. The formula for net profit is: net profit represents the final earning of the business after covering every expense. It shows the actual financial gain of the company. Net profit example. Continuing the previous example. Gross profit is equal to 35,000 rupees. Now suppose the business has rent is equal to 8,000 rupees. Salaries is equal to 10,000 rupees. Electricity is equal to 2,000 rupees. Advertising is equal to 4,000 rupees. Interest is equal to 3,000 rupees. Total indirect expenses is equal to 27,000 rupees. Therefore, net profit is equal to 8,000 rupees. So even though the business initially earned a gross profit of 35,000 rupees, the final actual earning after all expenses was only 8,000 rupees. Main difference between gross profit and net profit. Gross profit and net profit are both important, but they serve different purposes. Gross profit, calculated first, includes only direct expenses, measures production or trading efficiency, helps analyze product profitability. Net profit, calculated after gross profit, includes all expenses, measures overall business profitability, shows the actual earnings of the business. A company may have a high gross profit but still have a low net profit if its operating expenses are very high. Conclusion. So remember this important accounting concept. Gross profit shows how efficiently a business produces or sells its products. Net profit shows how much money the business finally earns after paying every expense. That is why high sales do not always mean high actual profit. Understanding the difference between gross profit and net profit is one of the most important foundations of accounting, commerce, and business management. Follow for more easy and detailed commerce explanations.